The World Bank has cautioned Ghana over any consideration for a return to the international capital market anytime soon. The World Bank, in its Ghana Public Financial Review report, revealed Ghana's expenditure grew faster than the growth rate recorded in the last 12 years, with 70% of it dedicated to public wages, interest payment, and earmarked statutory funds. Meanwhile, the World Bank Country Director, Robert O'Brien, is asking government to be fiscally disciplined. He was speaking at the launch of the report.
Reports from the World Bank explore the critical role of effective fiscal policies and public financial management in achieving sustainable and equitable economic growth. World Bank Country Director Robert Taliosio said a premature return to the international market could send the wrong signals to the market and a reversal to unsustainable borrowing costs.
As a point of history, Ghana has requested a record of 17 IMF programs, and as a result, the country has been in IMF programs for 40 out of its 68 years of history. So I think this does drive home the point about not returning to business as usual, but moving on. A premature return to international capital markets could send the wrong signal and reverse unsustainable, and also a reversal to unsustainable borrowing costs. I think it's critically important at this juncture in Ghana's history from the World Bank perspective that it sends strong signals about credible reforms and including structural reforms going forward. That would be the really great signal to send.
He further indicated that a not fully completion of the adjustment program reducing debt to GDP ratio to 55% by 2028 could jeopardize the credibility of policy reforms and the fundamentals for long-term growth.
Not fully completing the adjustment program, that is reducing debt to GDP to 55% by 2028, could jeopardize the credibility of policy reforms and the fundamentals for long-term growth. Hence, it's important to initiate a reset, as His Excellency President Mahama has said, to maintain momentum and stay the course with the ongoing reforms while deepening efforts in specific areas. One of those areas is strengthening fiscal discipline to ensure that effective expenditure management and control. Government expenditure grew faster than GDP between 2010 to 2022, and about 70% of this growth was dedicated to public wages, interest payments, and earmarked statutory funds. Another key priority is boosting domestic revenue collection to enlarge fiscal space. Collected revenue as a share of GDP fell to 13% by 2021.
The World Bank is asking government to address the growing fiscal liabilities from SOEs, namely in the energy and cocoa sectors. James Eshen's report for Joy Business.